Welcome to the Dividend Talk podcast, episode 105 Dividend Growth Investing with Nathan Winklepleck. Hey guys, welcome back to another episode of Dividend Talk. Today, European DGI and I are joined by Nathan Winklepleck, who is the author of Dividend Growth Machine. We'll chat about all things dividend growth investing from the United States and Europe. All that and more. See you on the inside. Hey, European DJI. How are you this Friday afternoon?
Good, actually. I mean, I haven't checked the stock market this week, so that was always liberating, right? But I hope my portfolio is doing well. I believe so. And other than that, yeah, it was busy as work usually, right? But holidays coming, so I hope we will have a bit of a slowdown period at work, so I can focus a little bit more on checking where I am. I guess I need to do kind of a mid-year review coming up for my portfolio.
Nice. Nice. I don't know if you can see behind me, but there is sunshine in Ireland, which is something a little bit rare, especially this year, and it's quite nice. I'm wearing a t-shirt, which is the first time since last summer, so I'm quite excited actually for the weekend. It's here to stay until Sunday, and then it's back to rain. So it's short-lived, but I'm also excited because we have a guest on the show, and this guest was recommended to us by the community. So I am happy to have Nathan, who is the author of the Dividend Growth Machine, joining us. Nathan, how are you?
I'm doing very well, Derek. Thanks for having me on the show.
So, just for those who maybe don't know who you are, could you maybe just give us a brief intro about who you are and a little bit about what you're about?
Sure, be glad to. Yeah, I'm Nathan Winklepleck um, from the United States, Indiana, as the state. I grew up there in a small town, and yeah, I've been investing personally since 2008, which I'm sure we'll talk about at some point. That was my first investment, probably about the worst year you could imagine starting investing. But yeah, I always, when I went to university, I always wanted to be involved in finance in some way, shape, or form. Always really enjoyed just helping people with basics on money management, investment management, budgeting, just everything. I think it's really interesting and also an incredibly important skill that a lot of people don't learn, maybe develop some bad habits, not taught by parents, and then our at least in the United States, our school system does not do a great job of educating people about money and investing in particular. So it's always been a passion of mine, an interest of mine, and so I actually, once I graduated university in 2012, I joined an investment firm located in the very southern tip of Indiana in a town called Evansville. And that firm actually that's what introduced me to dividend investing. The firm's strategy was entirely dividend investing oriented. And so I've been working there, since 2012. And that's really, I guess, where my interest in dividend investing began was working for that firm back in 2012. And then in 2015, I wrote the book Dividend Growth Machine. Actually, I published it under a different name. So my actual name is Nathan Winklepleck. I published it using my wife's maiden name. Her maiden name's King. So she major downgrade from King to Winklepleck on the names. But anyway, so I published it under Nathan King, and I really didn't think anyone would read it. So I have this book on Amazon, and it starts selling, and then the firm starts getting calls, and the people would call and say, "Is there a Nathan King that works there?" Well, no, there's not. So then it got to where I went to our president and I said, "Hey, I wrote this book. I didn't really think anyone would read it. but it's become fairly popular on Amazon, and so we talked about it, and he was very supportive and said, yeah, change your name, make it who you actually are, instead of a pen name. So, anyways, that's how the book got out there, and then yeah, really ever since it's been fun just to hear from readers. I mean, people have read it and said, hey, this is really easy for me to read, really easy to understand. And so that's it's been wonderful just connecting with different people in the community and kind of bringing new people in, I guess, to the dividend investing community. And so, anyways, that's I probably talked too much there, but
No, that's quite fine. I mean, it's a pretty awesome story, and putting it under your wife's name is hilarious. But I completely understand, because I would probably do something as well if I released it, because you just never think anyone's going to read what you write, which is I think we all suffer from that. But what made you write that? Why did you write the book?
yeah, so the book was really in response to some conversations I'd been having with my father-in-law. They were considering retirement and just different investment options, and so I had talked with them a little bit about dividend investing, and he was struggling to understand the concept that the dividend is unrelated to the price, and the dividend could grow each and every year, even though the price could go down, right? So he was struggling to understand that concept, and I thought, well, why don't I just write this down, and he can read it. Maybe that'll be a little easier for him to digest. And while I was writing that, I don't know, it's kind of morphed into a book. I threw in some chapters, and I thought, well, I'm 80% of the way here. I'll put together a little book cover, and it's not difficult to publish a book on Amazon. For anyone who's impressed with me as an author, at least me, anyways, there's no publisher. I just put it on Amazon. There's nothing overly fancy about the whole process. But yeah, just put it on Amazon, and really haven't made changes since. It's just kind of taken off a little bit from there. So, but yeah, the original motivation was just educating my father-in-law, really.
Well, I must really compliment you for it, because I read it. It's like probably a 3-hour read or something like that. And I really like how you really start talking about investing in general, and how what the benefits is it, but also I really loved like how you connected dividend investing to, let's say, the ultimate best investment strategy, right? So you have like 5 items in your book, like, and all boxes tick for dividend investing, and it resonated really a lot with me. And what is nice is like it's really in simple, plain English, and it's definitely something you can easily do, give as a gift to people, right? Just like find a Kindle or something like that, instead of having a whole long conversation indeed with people to convince them or to talk with them about it. You can just say, like, okay, read this book, spend 2-3 hours on a summer day, and tell me what you think, right? And I think usually those books are too complicated, go too quickly into valuation methodologies and such, and that's so nice about this book, that it kind of avoids it, right? Okay, but more about that later. Maybe this also a good time to first maybe go and look a little bit into the news of the week, because Derek also, I mean, there are 2 items I would really love to discuss, and also for you, Nathan, probably good to hear your thoughts there. But the first one is that we talk a lot about Unilever on this show. It's one of the most iconic dividend-paying stocks in Europe. And they are in a battle at the moment with Ben and Jerry's, because Ben and Jerry's decided to stop selling ice creams in Israel. Unilever board couldn't really intervene, because when they made the deal with Unilever to be acquired, they had negotiated kind of sole independence over the marketing and the brand and everything. So what in the end Unilever did now, it sold the Israeli part of the Ben and Jerry's business to another firm, so that they can continue selling ice creams there, and lift the ban on the sale of ice cream. And when I read this, I felt like we have so much complaint about the Unilever CEO, right, who also wanted to buy the consumer business from GSK for an unfathomable amount that they would never earn money back on. And it's again such a failure for me, because if you're like Unilever, right, and you position yourself as a company that wants to have also the trendy startups and everything, like they had also this, not Beyond Meat, but the other vegan meat, right? I wonder, like, if you see this, who wants to be acquired by Unilever, right? If you just get played like this.
Are you familiar with Unilever, Nathan?
I am familiar with it. I'm certainly no expert on it by any means,
Yeah.
but I am familiar.
Yeah, I mean it's quite astonishing what they have done, and selling the rights of a company that they basically own, selling the rights to a particular nation, the Israeli rights, from under their feet is baffling. I don't know what the board or the CEO expected the outcome of this to be. I know a lot of shareholders, maybe retail shareholders, are not quite happy that this has happened. It's like a big joke at the moment, the company. So we are quite, I would say, it's a large position in my portfolio, so I'm quite concerned over this. And over the last year, there's been maybe 3 or 4 or 5 instances where the CEO has showed a little bit of incompetence in how he's handling stuff. So it's quite a huge concern. I'm not surprised that Ben and Jerry's are now suing Unilever. I would probably do the same if I was in their shoes. I mean, I think the obvious action here would have been to spin off Ben and Jerry's and let them do their own thing. But it's turning into a bit of a pantomime over there at the moment. And
Good.
and what about and this is probably more applicable to you, Nathan. What about the European euro and the US dollar? They're almost on parity right now. It's crazy, right?
It is wild. Yeah, I think the obviously the U.S. Fed action is driving quite a bit of that, and then inflation obviously in Europe is pretty bad. So yeah, just aggressive Fed action that doesn't seem to be relenting anytime soon. But we'll see what happens. It seems like there's some signs that inflation, at least here in the States, are starting to roll over just a little bit. So that may help a little bit with the dollar's strength. But for a long time, we've said here in our meetings, anyways, that the U.S. has kind of been, just looking across countries across the world, the U.S. has really been a strong place to be for a decade now. Kind of someone in our firm calls it the best house, on a bad block. It's not like we have a great economic growth over here. It's just relative to the rest of the world, particularly, in Europe, as you guys are aware, it's pretty tough over there right now, at least from some of the numbers that we're seeing. So.
Yeah, I think the issue here also for many retail investors is, and I get this question continuously, should I stop buying US stocks at the moment and rather focus on European stocks because it's just getting too expensive with the foreign exchange here. But I was also wondering, like, how does it influence on the other side of the pond? In America, for instance, are people worried about the impact on earnings or a contraction of export and such? Are these kinds of conversations that are happening, and how it might impact the American economy?
Yeah, we've had several conversations just internally about companies that have a lot of overseas exposure. Maybe they have 20-30% of their business in the United States. Obviously bringing that revenue and earnings back to the US is painful for them on the earnings side. But we've really focused more domestically, buying businesses that have more US only exposure, just for that very reason.
Yeah, makes sense. The good thing is my dividend income is growing just as quick because, at least the dividends are having much more favorable currency right now. So I just see my annual dividend income figure, my PADI, I just see it increasing every time when the US dollar gets stronger. So that's a good feeling, but I know it's probably temporary. And if not temporary, well, then it's just a blessing.
Yeah, but you still reinvest them dividends, right? So it's probably
Yeah.
not much of a gain if you're buying at a.
Yeah, the issue here is really like with these brokers, right? Because they they transferred everything back in euros. If I want to reinvest again, I'm buying dollars again as well, and you pay the FX fee as well on top of it. So yeah, it's you know, I guess we're also all price anchored around a certain dollar. Yeah, like many of us were anchored around 120, I think. But I must say, in 2014, I was anchored around 160 or 150. That came out of the Great Recession. Yeah, so it's also just a snapshot in time. Maybe later it will be 80 cents, and then we'll be anchored around what it is today and think like, oh, I wish I bought more right now, right? So for me, and we had also a question around this. For me, it is really also here again about dollar cost averaging. Just try to ignore it as much as possible, even if you feel it hurts. You don't know if it will be up or down a month from now or half a year from now.
Yeah, I think that's a great point of, I guess the way I've always viewed currencies is over the next 30, 40, 50 years, the impact of currency on your investment portfolio is probably going to be pretty low. Maybe it helps you a little bit, maybe it hurts you a little bit, but over a very long period of time, what matters most is how are the underlying businesses doing. And I think that's the most key thing to pay attention to. But obviously, you run into some valuation issues where if you've got the dollar going up, maybe it doesn't make sense any longer for you to buy a future stream of dividend cash flows at those prices that you have to pay. But aside from that, I think it's kind of akin to market timing, right? Currency timing.
Yeah.
It's just hard to say. Maybe now marks the absolute peak of the dollar, and
Yeah.
we go down from here. So it's hard to say. I've always loved Warren Buffett's standpoint on macroeconomics. Just he doesn't try to forecast the market, doesn't try to forecast currencies or interest rates. Just buy great companies, hold them for a long time.
Yeah.
And
And in this
it'll work
case,
itself out.
in this case, it's really not that bad because also stocks declined 20% on average since the beginning of the year, and the dollar got only, let's say, 15% stronger over a whole year period. So we're still benefiting bottom line compared to a year ago. So it's really not that bad. But maybe this is also a time to do a rapid fire round, Nathan, now that we had the news. And before also to get to know you a little bit, and we will have some more questions later. So what I will do is I will put 5 contradictory, let's say, things opposite each other. You can choose which one, and then afterwards you can clarify yourself for 1 or 2 choices if you feel the need for it. Ready for it?
I think so.
Good. So the first one, would you prefer Altria or Philip Morris?
No preference. Neither.
But you have to choose something, Nathan.
Oh, I
Sorry.
have to choose something. Okay.
Yeah.
I'll choose Philip Morris.
Philip Morris? Good. Football or soccer?
Soccer.
Warren Buffett or Charlie Munger?
Charlie Munger.
High yield but low growth or low yield and high growth?
Low yield, high growth.
Then the last one, Katie Wood or Chamat Palihapitiya?
You saying Kathy Wood, right?
Yeah, Kathy Wood.
Is that what you're saying?
Yeah,
Oh
Kathy.
yeah. I don't know who the other person is, but I'll take the other person.
Chamat. He's the Indian-looking Canadian guy who's always on CNBC with the Mr. Speckman.
That shows you how much I watch CNBC. I have no idea who that even is. So I'm going to go with him though, because I'm not a Kathy Wood fan. So he has to be better.
Great. So, would you like to clarify one of your choices?
Yeah, I think you had a couple that were interesting. The low yield, high growth question versus high yield, low growth. Can I do 2?
Yeah. Go on.
Yeah. Okay. So that one, I think, to me at least, most dividend investors starting out with, that's probably the biggest mistake, is going after high yield for high yield's sake. Obviously, you prefer high yield and high growth right? You're getting a really good value in that case. But I think people underappreciate the power that a rising dividend has, both from an income standpoint, but also prices tend to follow dividends over time, right? It's like if you have a real estate property and your rental income doubles in 10 years, the value of the property, right, should roughly double. Maybe it's not
Yeah.
exact, but
Yeah.
I think that's a powerful, one of the most powerful reasons to focus on dividend investing. But it only comes to fruition if you have a healthy dividend to start that can continue to grow, and
hmm
the business has to have enough money to reinvest back into itself to get that future growth. And if you're paying it all out as a dividend, you've got to issue equity or issue new debt
Yeah.
to fund the projects. And that's generally not a great outcome long term. And then I thought the Munger Buffett question was interesting. To me, Buffett without Munger would still be a great investor, but I don't think he would be anywhere as famous as he is today. To me, Charlie really brought to him the idea that it's better to pay up a little bit for a really wonderful, great business that's compounding internally at a very rapid pace, and not be so focused on buying, cigar butts, as Buffett would say.
Yeah.
It's not a real appealing company. It's got one puff left and it doesn't cost you much. But the long-term compounding nature of some of the businesses like See's Candy that they bought, I think that was in large part something that Munger convinced Buffett to do. And the other benefit of that, obviously, is we were talking about taxes before the podcast. You essentially defer indefinitely the taxes on
Mhm.
those gains.
What is interesting is that it kind of is a similar answer as to the high yield, low growth, right? If you replace high yield with cigar butts, and yeah, makes sense. Makes
Exactly.
sense. Yeah. I'm reading still Charlie's Almanac. I bought it with Christmas, and it is simply brilliant. All the lessons in there, also how he grew up. So much wisdom in there, and also where he took the wisdom from, right? By reading, was it ancient mythology or Greek mythology or something like that, and how he applies that to investing, because he treats investing really as psychology as well. And I find that really, really insightful, I must say. And it's kind of next level consciousness about investment to compare to what we see daily on social media and the news and such. It's a consciousness I haven't reached yet, I must confess.
Yeah, his
Cool.
focus. He did a talk on the I forget what it's called, the 32 psychological misjudgments or something. I'm butchering the title of it, but that's a really brilliant speech to listen to if you guys haven't heard that. The point about investing being psychological, I think that's something I've learned over the years. Is I think there's an argument to be made that maybe dividend investing isn't the best, right? You could find a better strategy out there, probably. I think the best would be finding a See's Candy, right? Or something that is able to reinvest at 20, 30, 40%, right? Or I guess the simple case of Warren Buffett, right? If he is investing our dividends on our behalf, he's going to get a better return than we are, right? So that makes a lot of sense. But I think those types of companies are few and far between. And the other thing about dividend investing, I think psychologically it gives people something to grab a hold of. You get a market like we're in now where prices are off 20%. It's easy to look and say, you know what, I'm still getting my dividend payments. So people are able to stick with it when otherwise I don't think they would. And it also really acutely aligns you with thinking about stocks as businesses, right? Instead of just ticker symbols on the screen when they're paying you real cash flow. That hits home a lot more with people. then the only way to make money is if the stock price goes up.
Yeah, definitely. I've also seen that more new dividend investors are entering the community, specifically after the washout we've seen over the last year with growth stocks. And I think that's one of the attractions in there, because dividends are just not so volatile. I mean, you really need a dividend cut to see a decline in your cash flow, right? And if you're well diversified, the other companies that are increasing and hiking the dividends are usually carrying the weight of this single dividend cut. So in the end, you're not really losing money, maybe just based on inflation if you compare, but otherwise than that, usually a lot of it, if you really go for a dividend growth investing strategy and buy high quality companies, it's really hard to see declining dividend income over time.
But you also have to have patience, don't you, for such a strategy? And we see, you spoke on it. We have seen an evolution, particularly on social medias, where maybe 2 or 3 years ago, dividend growth investing was in when coronavirus, but then people quickly shifted to growth stocks, and it's hard. It's hard when you're, say, a retail investor reading people getting high returns on these stocks, but then they lose it all just as quick. So I think patience is and the psychology, as you mentioned before, is quite important going down this route. I think it's definitely a long term investment. But in saying that, I know you spoke, you got into dividend investing from your firm, right? From your work. Do you think you would have invested? Would you have gone down this route without that firm, or did you have other ideas when you were studying and coming out of college?
That's a good question. Coming out of college, I was very much a Buffett disciple, so to speak, but more from the standpoint of value, deep value companies. And I remember talking to the founder of our firm. I was looking at Ford, and it had a really low PE ratio. And he told me, a lot of times a company like that's really cyclical, it has a low PE, not because the P part is low, but because the E is at a cyclical high. So it appears to be cheap, but it's really not. So that was a lesson for me to learn. I don't know if I would have gotten to dividend investing. I think maybe I would have, but maybe more through less through the route of explicitly to get the dividend income, more through the route of buying high quality businesses. I think high quality businesses tend to also be dividend payers because they have way more cash in most cases than they need. So they're paying back some of that to shareholders via dividends or buybacks. So I think I would have gotten to a dividend portfolio more from the standpoint of quality business, less dividend income specifically, if that makes sense.
Yeah, no,
Yeah,
perfect
makes
sense.
totally sense. I actually went the other way. I fell in love with dividend investing, but I started to appreciate value investing over time as well. So I always consider myself like a value-oriented dividend growth investor. So because this analysis is really, really important, and I can't really distinguish it from each other, but I exclude value stocks that don't pay a dividend. That's rather how I could say it. Yeah. So, and based on that, right? What is your goal? What is your purpose? Let's say with investing in it such. What would you like to achieve with that in life?
Yeah, it's been an interesting, I guess, evolution for me. When I first started for the firm and got married, actually got married a week before I started working with the firm. So if I ever forget my work anniversary, I'll also forget my. I can't ever forget my work anniversary, right? That means I forgot my forgot my other one. So, anyways, uh, so I think when I first started investing, my goal was financial freedom. There was a blog I read when I was young called Mr. Money Mustache.
Ah, yes, of course. Everyone read that one.
Yeah.
Yeah, that's a classic blog. I really enjoyed reading that. And so that became my obsession. I guess the FIRE movement, I was probably one of
Mhm.
the early adopters of that. idea. And so I would do things to save money. I still have a reputation. It's funny at work. I have a reputation for being super frugal, and I think to some degree that's not the case as much anymore as it was. But I've got some funny stories that I won't share here, but just ways to save a couple dimes to invest a little bit more. And I think over time I've really evolved away from that. And I think the main reason for me is I guess the motivation for retiring early is you don't want to work, right? You don't want, or at least you don't want to do whatever you're currently doing. You want to have the ability, the freedom to quit that and do something that you enjoy more, or
Mhm.
maybe just the psychological, I want to feel like I can leave anytime and money is not the object. But I think for me, I've learned that I don't really want to stop working ever. Hopefully not ever. I really enjoy what I do now, and I don't see myself, I guess, ever truly retiring. And so the objective of being able to retire early just doesn't have the same appeal that it maybe had when I was younger. So it sounds a little cheesy. I guess the other part of that is, I don't want to leave a ton of money to my children. I think I've seen a couple times where money has ruined kids that get a bunch that they didn't have to work for, and it usually gets blown. They say that the first generation earns it, the second generation maintains it, and the third generation blows it. That's probably a pretty accurate. So I don't know that I want to leave our kids with a ton of money. So I think investing for me has become, I think, more of I like to learn new things, and I like to be challenged. And so I think investing represents kind of the ultimate challenge, right? You're essentially competing against millions of other extremely intelligent people trying to make smart investment decisions. So it's the challenge, the kind of infinite pool that you can learn and learn and learn and never really exhaust the depths of all there is to learn. But I also really enjoy teaching. I think that's, so, as cheesy as it sounds, I think my goal is with investing is, I think, to educate others about investing. And I find a lot of satisfaction in that, and just being able to explain things in a really simple way for people to understand and maybe not make as many mistakes as they would have otherwise. So I think of this, for me, it's there is a component of financial freedom and wealth building to some degree, but it's far less of an emphasis for me at this point in life. Just want to
And is this then also the reason that you started a YouTube channel?
a little bit, yeah. I actually I originally started it because I knew it would be hard to build a YouTube channel. And I wanted to prove to myself that I could stick with something for a long time. This might be just a personal flaw of mine, but I struggle to stick with things. I like the challenge of something new, but then I'm ready to move on once it becomes somewhat of a success. So I've had people say, "Hey, you should write another book," and I've thought about writing another book, but it's kind of like, well, I did that already, and it's kind of, so I guess YouTube was something that was a little bit of a challenge, and also, yeah, just that I think love of teaching, but also it forced me a little bit out of my box. I don't like to be at the center of attention. I don't like to see myself on a video screen. It's not something that I find intrinsic enjoyment out of, uh, but it has really increased, I think, my presentation skills, and just gaining confidence, and also understanding, what resonates with people, what doesn't, what are they clicking with, what's still difficult for them to understand. It's been a really fun way to just kind of stay involved in the community. And I know you guys have experienced the same with the podcast. You build a little community, and it's just a lot of fun to interact with, the same people will comment, and you comment back. It's just a lot of fun. Meeting people, talking to them, having Zoom calls with a couple people that have reached out from all over the world. This opportunity to be on your podcast, this would have never happened without the book and the YouTube channel. So I think just getting yourself out there. Maybe no one wants to read whatever book you have to write. Maybe they don't want to watch your YouTube channel, but maybe they will. So I would encourage any of your listeners that are thinking about doing it, just do it for yourself, do it for your own growth, do it for other people's growth, and maybe
Nice.
yeah.
So
And-
so
and
go on, Derek.
Do you believe then in writing the book and doing these videos, does it make you a better investor, or does it help you evolve into being a better investor?
I think it does, especially writing. There's a power, I think, in writing, in that it teaches you what you think, and it clarifies really for yourself what you actually think. A lot of times I think we have these thoughts in our head, and we maybe think we understand something, or we think something, and when you sit down to write it, you find out, maybe I don't know this as well as I thought I did, right? If you said, okay, I want you to, every time you buy a stock, sit down at your computer and write, a couple paragraphs on what the business does, why you like it, why it's a good investment. And if you can't do that in a written document, that probably is a sign that you shouldn't do it, right? So writing really clarifies thought in a way that I don't think anything else really can. And it also forces you to have like a logical, coherent process, especially if someone else is reading it. You can't skip over things that maybe but your audience doesn't know. So you really have to go to the level of your audience, and kind of build them up to where you are. It's also helpful, I think, in Charlie Munger is big on, having your thoughts be connected. You have to connect whatever you're learning to like a lattice work of things that you already know. And so it's really useful, I think, in creating analogies and just coming up with links that maybe I wouldn't have otherwise done without writing.
Yeah, I think we both can definitely concur to that. And by the way, we will put the link to your YouTube channel and to the book also in the description of this show if people are wondering. And I would definitely recommend also to check out your YouTube channel, because you have some really nice videos on there, like also where you talk about your biggest learnings. Maybe we'll get back later to that. But for me, it was also quite ironical that your most clicked video is about QYLD here, and you're debunking myths there, right? And last year it was really a hype, QILD and all these kinds of I said these kinds of, I don't even know, do you call them ETFs? I don't know even. But could you tell me a little bit, like, how do you look at this, that it actually got so popular, and to you also as a YouTube creator?
Yeah, YouTube's interesting. I guess I am not surprised it's popular. I don't think it's my best video at all, but I think a lot of times as investors, and specifically in the YouTube community, people are looking for answers, right? Like, I guess I think of it, I heard this quote from Michael Geyer. He did a CFA event here locally a couple weeks ago, and he said, professionals want to look to the left of the equal sign, and amateurs want to look to the right. So in essence, the amateur just wants to know the answer, and the professional wants to know, how did you get to the answer? And so that's my concern. I think people thought I was really ragging on QILD. I think it's a perfectly fine investment vehicle. What I don't agree with is why people are buying it. I don't think people really understand, I guess, to the left of the equal sign. All they look at and say, oh, it has a 12% dividend yield. Well, yeah, it has a 12% distribution via covered call premiums, but that's not the same as a dividend, right?
Yeah.
It's an option premium. You're selling the upside to the investment, and you are mitigating downside to some degree, but not. You're still basically taking on the risk of the underlying. And so I just think it's important for people to not just look for the answer or what someone else believes is the answer. You know, even look at Warren. What did Warren Buffett buy? Oh, he's buying Occidental Petroleum. Does that mean you should buy it? Not necessarily. You know, is it? Every person has their own, you know, circle of competence. You know, that's a big kind of buzzword, but you know what someone else is an expert in and what I'm an expert in are different. And so I just think it's important for people to understand what they own and why they own it, because you get into a bad time. And you could say you bought Amazon, you know, 25, 30 years ago. It's gone down 80%, I think 3 times, right? So the odds that you would have actually held on to that stock the entire time to realize all of those gains is extremely minute. The only way is if you really truly understand it very well, very thoroughly, and that's what gives you the you know, psychological I don't know what the word is,
Yeah.
gumption or whatever, to hang on to it even in the bad times. So I just doubt for QILD people really know what they're buying in a lot of cases.
So what some people told me is like, hey, DJ, I just need 4 times less capital to get to the same income if I would invest it in a blue chip company last year at 2.5% yield. If I can get QILD at 10% yield, I just need four times less capital to early retire, right? And yeah, I always told them, like, your capital is not protected. Yeah, here it will wave with the market's ups and volatility, let's say. Well, if you buy a dividend stock, high quality, your capital is kind of protected, maybe not in the short term, but kind of more in the long term if the earnings continue to grow, if the business model is strong. And this is difficult really to assess with such kind of ETF, let's say.
Yeah, I also difficult. I mean, essentially what you're saying there is, you know, there's an old study, the 4% rule, that I don't know that I entirely agree with. You know, it's back from the 1990s, but the idea being that you can safely withdraw 4% of your portfolio, you know, each year for 30 years. And that's kind of the total return approach, right? Dividends and capital appreciation, and then also bonds. But I guess I find it difficult to say, wait a minute, all of this past research on distribution rates is actually completely wrong. 4% isn't the minimum, it's actually 12%, right? You can safely spend 12% of your portfolio each and every year and not run out of money. I don't think the laws of finance are all of a sudden suspended to the degree that now you can spend 3 times more than, you know, what a landmark study suggested, and expect it's not going to run out.
Yeah, exactly. And we have seen now also because the same group of people also went to all these kind of, how is it, crypto payments and dividends and such. And we see now what's happening with even Voyager going bust, right? So Celsius as well. So I think it comes down in the end also to often to the nature of people to chase for yield. And this is, I think, the psychology that is hard. We also have it sometimes that we discuss here in the podcast, like the fear of missing out. Yeah, that's really strong sometimes. So far, I've been able to stay away from that crap, and I hope I will continue to do so, because I just need to watch more often in those times to my dividend income reports, which are nicely chugging along and compounding, and I think that's really the biggest power. So.
I do think it's, if somebody, I think I said this to someone in a comment, but if somebody really believes in QILD and that is what's going to get them to start investing, and they really believe in it and they're going to keep putting money into it, I guess I've kind of come to the point where you just need to have a strategy that you personally believe in, and that is going to be probably better off for that person than if they just sat in cash or, you know, bought crypto or something. If it's something they can stick with long term, who are we to sit here and say that's a bad idea? Sometimes it is a bad idea, but if it's something you really believe in, you know, go
Go for
for
it.
it, right? Yeah, just do something. Don't compare yourself to anyone else. Just
Cool. So what are then some of your favorite dividend paying companies? Some companies that you believe in?
yeah, I've always been a fan of more low yield, higher growth, and also businesses that I have personal experience with. So I really like Costco is one of my favorites here in the United States. I think they have a little bit of global exposure, but primarily here in the United States. I shop at Costco on a weekly basis. I understand it very well. I understand from a consumer side why I would continue to renew my Costco membership, and that's pretty much the only way Costco makes money is just they just want their members to continue to renewing their memberships. That's how they make their money. So it's essentially like a group buying. Like, I pay them $60 or $120 a year, and they use their cumulative buying power to negotiate on my behalf all of these different products and services from insurance. We either refinance through Costco, it saved us a couple $100 a month on our mortgage. So it's an incredible business, and it's one I think Charlie Munger owns some obscene amount of Costco stock that he's had for many decades. But it's something that if I think about the biggest economic moat in the retail industry, I cannot fathom a bigger moat than Costco, right? It's how do you compete with a business that does not need to make money selling cereal, right? They can literally make 0% on cereal. The only way they're making money is on the membership. You cannot compete with that if you're Walmart, right? The only way you make money as Walmart is you got to mark up the price of all those items, and that's how you're making a profit. So for Costco, they can essentially undercut everyone permanently on everything. As long as you pay the $60 a month, that's their profit, and you can use it as much as you want to use it. So I think that is an insurmountable moat. I really like Costco. It's a little pricey at the moment, especially if you look at just from a PE standpoint, it's over 40 times earnings. So you are certainly paying a premium for it. I guess I'm talking more the business itself. I really like that business. Apple, obviously, I'm a huge fan of Apple, and that's my biggest investing mistake. I guess we can talk about that in a minute, but I think Apple's another one. I joked with a friend of mine. I said, I think if you built a portfolio only with the businesses that people have either a tattoo of their logo on their body or some sort of sticker on their car, the products that people love to buy. And I think Apple is in that camp. People love Apple products. They'll pay $1,000 for a phone that has the same components as a $400 Android, but they'll do it because they love Apple. They love the ecosystem, I think is incredible. So Apple's one. Home Depot, again, we're mostly US businesses, but I think that's an incredible retailer here in the United States in home improvement, professional remodeling. I think Visa and MasterCard, I've always loved those businesses. Just the network effect, I think, is very difficult to be eroded. Blockchain may have some inroads. We'll see if that really takes off over the next couple decades. Maybe we don't need, Visa and MasterCard to facilitate transactions, but that's been an incredible business. Just really high returns on capital is usually what I'm looking at, and then also businesses that I personally shop at or personally use their products is really what I'm focused on.
So you teased us there a little bit about your biggest mistake. You have to elaborate a little bit more on that.
Okay, well, this is relevant. It involves Ireland, actually, so this will be perfect. Yeah, so when I was starting investing in 2008, I was getting ready to go to college, and for my college laptop, I wanted a MacBook, right? Like desperately wanted a MacBook. I ended up getting it. And I just loved this computer. I had an iPod, back when iPods were real popular. I knew a lot about Apple. I loved their products. And so I had a little business. I did auto detailing for the summer, and I had about $10,000 in profits from my detailing business. And I wanted to invest that money, right? And so I convinced my parents to let me open an account. And the stock that I wanted to buy was Apple. I wanted to put all $10,000 into Apple. And my only thesis was, I like Apple products. Other people probably like Apple products too. So the business will probably do well and the stock will be a good one to own, right? That's just a real simple thesis. And then I start reading online that I need to be diversified, right? I need to not just put all my money in one stock. And so I started researching these different companies, and I ended up buying no Apple at all. I bought 6 other businesses. One of them was the Bank of Ireland, and that Derek, you're laughing. A disaster. Bank
I
of
know.
Ireland in 2008 was not a good investment.
No, not
I
pretty.
also bought, yeah, not pretty. What was it? There was another bank in Europe that I bought. I've apparently blocked it out of my memory. The best performing stock that I had of the 6 was GE, and I think it was down, 55, 60%. I think the whole portfolio maybe dropped 80% or 90%. It was just a terrible performing portfolio. And then insult to injury was obviously Apple went on to, just absolutely soar. I think I calculated that $10,000 would have been worth, $290 or something like that. Again, assuming I would have held it and not taken any profits on it, it would have been worth that much. But it was good. My dad always says, I think it was best that you didn't have such great success at the start, because you were able to learn your lessons with, a little bit of money. You made some bad mistakes, which taught you a lot more. And you didn't, you weren't dealing with hundreds of thousands of dollars. It was smaller mistakes made, not as costly as it would be later in life.
I think he's probably right. I see this now also with people investing in Tesla. Like there are many people that only own Tesla since the early days, sitting on lots of cash. And I always wonder, like, when will they finally cash in on this? Like, because maybe there is a time that it will, go more to a normal valuation, let's say. So, yeah, this. I mean, General Electric. Tell me about it. I mean, it's horrible. I mean, Jeff Immelt at the time, he was good in talking about his stock, but he was not good in delivering at all. And I read the book Lights Out. It's astonishing how they've been fooling, and it's astonishing that some of those people are not in jail even, that they got away with it, right? But it says a little bit about the complexity or the lack of transparency for such large industrials, that even a lawmaker cannot really get anything out of it. Here, it's just too complex to even prosecute these people. It's yeah.
You mentioned Bank of Ireland, and I was laughing. What year was that? That was before the financial crash, I take it.
Yeah, 2008, very beginning of 08.
Yeah, so they were trading about 50 euro, because I remember looking at this with my friend who's also in the financial industry. I wasn't at the time. I knew nothing about investing, but I remember that crashed so hard, literally to pennies. It nearly became a penny stock, and we were thinking at the time, oh boy, we don't like banks, but this has to bounce back up to at least €5, which it has. It bounced, almost going in to invest all our money at that point, but never got around to it. But Bank of Ireland of all things, that's hilarious.
Yeah, I think I read about it for, it's something I probably read for 30 minutes or an hour about, and I read someone else's opinion, and I knew nothing about Ireland. I'd never been to Ireland. I knew nothing about banks. I had absolutely no business buying this stock. Why I did it, I have no idea, but it was as far outside of my circle of competence as I could imagine.
Yeah.
Like Pluto, basically.
Yeah. So I anyone that isn't investing yet and is listening for the first time, I would again recommend to to read your book, because, and actually on your YouTube you have also like this video, right, about your biggest learning. And I think they resonate really well with me, because the first one you said is like, don't buy what you don't know. So Bank of Ireland is probably a good example of this. Do your own research. Yeah, so don't copy it from someone that writes something on Reddit or even on YouTube, right? Or on a blog in our cases. Yeah, and this invest within your circle of competence. And could you before we go to the listeners' questions, elaborate a little bit more on that, what you mean with circle of competence? Because it is a quote we hear a lot, right? But I think many people feel they are doing this while they might not, and others might be wondering, what does it really mean? So what is your view on circle of competence?
Yeah, I think my favorite way to think about this, and maybe this is what changed my thinking on circle of competence. I guess it always used to be a bit of a buzzword, and I'd hear Charlie and Warren talk about the importance of your circle of competence. It kind of felt like I guess a tangential teaching from Buffett of, to me it was, okay, valuation's the most important, and okay, circle of competence, right, that's a great bonus. But over the years, I think I've come to view circle of competence as essentially enabling you to do everything else you need to do with investing. So you cannot value a business that you don't know anything about, right? How do you know what Unilever is going to grow at if you have no idea what they do, or you don't own any of their products or have any understanding of their business? There's no way you can value it, right? If you're investing in it, you're just doing it kind of on hope that it's going to do well, and you don't know why. And so I think, I forget where I heard this illustration. Maybe it was on a Berkshire Hathaway meeting, but there's a story about this guy, and he's been living in the same town for 50 years, right? Buying real estate. He knows that town better than anyone else on the face of the earth. And so that is kind of his circle of competence. He knows what the land values are. And then you have, some outsiders that have PhDs or whatever in valuation coming to this town and saying, oh, this lot's worth this, this lot's worth this, this lot's worth this. And the reality is, the person that is the best investor is the one that's been most familiar with that town. He doesn't necessarily have a fancy degree, or he doesn't get in Excel and calculate what the fair value of this land is. He's just saying, hey, this is a great piece of land, and here's why I know this area like the back of my hand, right? And so that is his circle of competence. He's going to have the best investment success investing within those places that he knows. And so I guess for me, investing, I think we overcomplicate it, and we try to find these genius investment ideas. And the reality is, you just, even, I guess the Amazon example maybe isn't a great one, but just think about, I did this video, and it's kind of a thought experiment of, I wonder if I went through my budget for the last 12 months and I calculated what were the 30 companies that I spent the most amount of money with, right? It would probably be Apple, right? Costco, I guess you're shopping with the, Visa, MasterCard. What are the literal items that you're buying on a day-to-day basis? Those are the kind of businesses that you understand, right? Because you're a customer of theirs, and so you know what value they're bringing to your life. And so you also then kind of have a sense of when they're no longer providing that value. So maybe you have a product that you used to really use a lot, used to love a lot, and now you don't like it as much because the quality is worse or whatever. I mean, that I think is a direct indication of how the business is doing. You have a pulse on that business.
Yeah.
That
sounds a
you
lot like
otherwise wouldn't.
sounds a lot like Peter Lynch and One Up on Wall Street.
Yeah,
Because this is what he's all
exactly.
talking about, right? Yeah. Cool.
Yeah, it's overcomplicating what is really just kind of a simple reality.
Yeah, and this makes it hard. For instance, 3M. It's such a enormous company with so many products for so many industries. It's almost impossible to ever call this your circle of competence. But both Derek is an engineer, works probably with some of those products from 3M. So at least for one part of the line of business, which might maybe represent 2% of their revenue, you get a feeling, right? And based on that, we extrapolate probably our assumptions towards the rest of the business. Yeah, and that makes investing so hard, and also in some of the blue chip companies, because they are not any more a single product company, right? They're so diversified that, and some are B2B. It's really, really hard to grasp them. And for me, then it's really falling back on, and this is actually what I spend time on customer reviews, going to YouTube to see an engineer using a valve or something like that. At least you get a bit of a feeling like what the engineers like, but even then it stays really, really hard for me.
I think that's a valid point, though. Even if it's a small part of their business, you do get a little bit of an idea of what the culture is like at a particular company. Like Derek, you might be able to talk about that with 3M. What's your experience with the people that are working there? Do they like the company?
Exactly.
I always think about just when you go to a retailer, right? You probably have a retailer that there's, they both do the same thing. There's AB retailer. To me, I think of Home Depot versus Lowe's. Both are U.S. home improvement stores. When I go into a Home Depot, it's a different experience for me than when I go to a Lowe's. Home Depot is much better ran, I guess. The customer service is generally always better. The people are friendlier. They're asking you if they can help you, whereas Lowe's, it's just you're kind of it feels a little bit more like you're a burden. And so I think that the culture of a business is really important. And you mentioned with GE, when you have I don't want to say corrupt leadership, but the integrity of an organization is something that generally springs up from the founders. And there's a certain culture that I think really great businesses have, kind of just a culture about them, that even interacting with a couple of their employees and something that may be a small product line, you can ask them questions, right? How do you like working for 3M?
Exactly.
You can pick up little details and do your research a little bit that way. If they hate their job and they think the company, they think the leadership is garbage, so that might be a pretty big red flag. But this might not be such a great business.
Yeah, that's why I don't invest in airlines either. I've never heard them being positive about their own airline. They're always complaining about their salaries and the hours. Good. Thank you so much, Nathan, for answering all these questions. And these were questions just from Derek and myself, right, having this conversation. But we have also a really active community. And also they were asking some questions. So we would love to use the opportunity to give them some space as well. And one of the first questions is from Anders Storgaard, and he calls you a badass, a hero of yours. And I said he would love to hear our guys or us discuss Texas Instruments a little bit in the current crisis in the chips sector. And do you have any opinion about this at the moment?
I mean, I guess I think about a business like Texas Instruments that's been able to grow its dividend for a long time, and sometimes the macro environment's good, sometimes it's bad, and I just think long term, think about Texas Instruments in 10 years, right? Do we still need more of their products and services? Yes or no? And I think the answer is yes. And so you go through these, it's obviously a pretty bad macroeconomic environment for them and other chips, but I think this eventually will pass, right? I think they're adding a significant amount of value to society. We are going to need more chips in 10 years than we have today. That's just a fact. Everything has a chip in it, usually multiple. So tough time, yes, but I think they're going to get through it, and just thinking out 10 years, I think this is a blip on the radar, probably longer term. And I did use, he's probably referencing the YouTube video I made on Texas Instruments. Full disclosure, I am not ever suggesting these stocks as buys as much as they're illustrations of, I guess in that case, the power of the rising dividend and the correlation between the price and the dividend over time. I think that was more the example there for Texas Instruments, was making the point that if you buy a business that can raise its dividend a lot in the future, the price more often than not is going to move along with it. So anyways.
I could say I started initiating a position in Texas Instruments this year, and I bought now 3 times, and I really like what it's trading at the moment. And to your point, I mean, with this everything going digital, and we're tagging everything, monitoring everything. I mean, we need so many of these analog chips. Like I just can't imagine that demand will slow. Maybe a small hiccup, like you say, but this is about to explode with the Internet of Things and everything. I just can't imagine that Texas Instruments will not be benefiting of this over the next decade. Yeah.
And if you listen to some earnings calls from some of the semiconductors, not Texas Instruments, but others in the space, at least as of the last call, they really weren't struggling with demand as much as it was meeting supply. I mean, the supply is the issue, not necessarily as much with demand. And the other thing I think is to always keep in mind that, Texas Instruments has been around as a company for, I think, since like 1930 or something. It's been around forever. They have lived through many different environments, and companies are not just static, right? They're not just saying, oh no, the macro environment's bad, right? We're just a victim to that environment. They are actively every day waking up. How can we solve this problem? How can we, move this manufacturing facility to a different country? Tax laws change here. What's going to be the best way to move forward? They're constantly dealing with all these challenges, and they're constantly maneuvering to do what's best for shareholders. And they're supposed to anyways. I guess you were talking about Unilever a little bit earlier, as maybe not that as much, but I think if you have a business like that can adapt to whatever environment it's in, it's just kind of a short-term headwind that I think they and others will get through.
Cool. Rafa has asked about the ROIC ratio and how important is that to you, and how you calculate it and so on.
Yeah, I think if you said, Nathan, you can only look at one financial ratio for the rest of your life, no others, what would it be to make investments on? I think it would be return on capital. And I think the reason for that, it just tells you, essentially you're saying, okay, if this business reinvests $1 into itself, it's going to generate how much, right? So if it has a 20% return on capital, if you add up, the equity and the debt in the business, $1 equals, 20 cents, right? So if you were able to if they invested all of their earnings back into the business, and they could do so at a 20% return on capital, they would grow by 20% per year, right? So the problem is that businesses don't have indefinite investment opportunities like that. So like if you look at Apple's return on capital right now, it is 51.8% in 2021. So if Apple could if they could maintain that return on capital and retain all of their earnings, we would not want them to pay a dividend or buy back shares. We say, Apple, you keep reinvesting at 51.8%, right? That is going to be better than any of us could make on our own. The problem is they're already so big, they're not actually reinvesting hardly anything back into their business. They're mostly buying back shares, paying dividends. So the amount that they're actually reinvesting at that rate is very small. And they have a ton of cash that actually makes that number appear artificially low. If you back out the cash, it's even more impressive than that. So I think it's the best indicator to me of a company that has a wide moat. So you look at, just compare two or three competitors, which one has the highest return on invested capital, that is most likely, not always, most likely going to be the best business. And again, that can change. Like you look at IBM. I just did a video on this last week. Someone was asking about IBM. Has a big dividend yield, but you look at its return on capital since 2012, it has steadily eroded from a 32% down to like a 7%. So that is not a good sign, right? And even Unilever, you've seen a little bit of that erosion. At least when on my screen, I'm looking at the U.S. Converted earnings, so it may be a little different in constant currency. But I think anytime you see a consistent and large erosion in return on capital, that's a worrying sign. I'm not saying you make all your investments based on that alone, but it's a pretty good one to look at.
Okay, good answer. We have another question from Phil, and he is curious to see how he would rank revenue growth, earnings growth, cash flow growth, and dividend growth.
Wow, that's a great question. I think I would probably say, I think cash flow growth would probably be the most important, but also the most difficult to understand, because if you're talking about free cash flow growth, a company they may make a ton of investment last year, and this year they make little, so their free cash flow could change rapidly. So I think that's a very difficult one to use. So I think at a practical level, that one might be not very high on the list, but from what is this business actually growing at, I think that's probably would be my top pick. I don't know, it's so hard to say. I think they're all very important. In the dividend growth, I think is what you're ultimately looking for. But there are some cases like, we talked about 3M earlier. If you look at 3M's dividend growth over the last, decade, it's been pretty impressive. I think it was in the double digits. I don't know what it is.
Except for the last year, let's say, or the last 2 years, it was almost a penny. But generally, yes, you're right. It was really impressive.
Yeah, so you had the 35% increase in 14, 20% increase in 15, but then you look at their revenue growth and it was 3.1% in 14, negative 4.9 in 15. Earnings growth was a little better, but you had 11.5 and 1.2. So they're increasing their dividend by increasing their payout ratio. So I don't know. I think you just have to be difficult extrapolating any of those numbers indefinitely. I think they're all important. Like even a business like I was looking at Mettler Toledo. They're like a weighing scales company here in the United States, healthcare company. They've had 15% earnings growth for the last decade, but their revenue growth's been 5%. So the question becomes, okay, well, obviously they're increasing their earnings via buybacks and via margin expansion. Can they keep doing that, right? And the answer is, I don't know. Can they keep squeezing 15% growth out of 5% revenue? Eventually, you run out of margins, right? You can't increase margins at the same linear rate forever. Eventually, you're going to kind of reach a point where you just can't get higher. It's just kind of the laws of the business. And so, I don't know. I guess I tend to look at the most conservative of those numbers. Like I'll usually take a look at revenue growth, earnings growth, cash flow growth, dividend growth. And, if you see revenue growth is 5 and everything else is, 15, I at least want to understand, can this business keep increasing their margins and what's the kind of upper limit to that before I start to project 15% dividend growth indefinitely. It's just, you have to take them all in context of one another. So that's a very bad answer to that question. I guess I didn't really answer it, but I think dividend growth is ultimately what you're going for, but the other three tell you a lot about what that's going to be. So they're all critical.
Okay.
You also have issues with revenue growth. You get sometimes a company will acquire, right? They'll make an acquisition, which adds to their revenues, but it may not actually they may not actually be growing organically. You have cash flow, or you have currency considerations, right? So 10% revenue growth, well, they had 7% benefit from currency translation. So you're always trying to get at what's the organic growth rate of the business, right? That's kind of what you're after.
Cool. And then the last question then, it comes from Kurt, who has asked, what are your main fundamental parameters that you use to buy a dividend stock?
Yeah, so we talked about return on capital. That's obviously pretty high on the list. I mean, I think obviously you want to look at payout ratio is a big thing for a dividend investor. There's also a little bit more sometimes than meets the eye, like IBM, for example. If you look at its just payout ratio right now with earnings, it's over 100%. So you may look at that and say, well, IBM's certainly going to cut their dividend. The reality is, if you look at the cash flow statement, they're investing a lot less today than their depreciation charges. So the earnings are using depreciation of, I think it was 6 billion or something like that, whereas they're actually investing roughly 2.5 billion today in new investments. So they have plenty of cash flow today because they're not actually that 6 billion is just past investments they've made that they're getting charged for today, right? And so they do have enough money to cover the dividend. So I don't know. I hate to kind of oversimplify things with ratios. I feel like a lot of times the ratio is helpful. So I think that maybe the spirit of the question is, if you're making a stock screener, right? Like what parameters are you using for a stock screener?
Yeah.
I don't know. I just find those very difficult to do. Saying I want a dividend yield of X and a payout ratio of X, and that can either exclude or include companies that shouldn't be there. So I don't know. I guess I always just start with return on capital. Just looking for companies that have consistent. I think just consistency of earnings and dividend growth is a good thing to see. You look at something like a Ford or GM or something that has extremely volatile earnings. I think that's generally something you would want to avoid. But I don't know. I find looking at just static ratios to be really not terribly helpful. I mean, even return on capital can be high in one year and low in another. So you get head fakes. So what I typically do is, if I'm looking at a company, I go to a site called quickfs.net. Maybe we can put a link in the show notes, but they give you 10 years of financial statements for free. And I think you might have to pay to get to the cash flow statement. I pay for it. I really like the service, but it puts everything right there on the front. They have a return on invested capital chart very prominently. So you can really quickly at a glance see a lot of important things about a business, not just the ratios today, but kind of what they've been in the past. So, if you pull up something, you can see, okay, revenue growth is, generally been around 5%, but all of a sudden they have a 30% year, right? And it's like, well, maybe they did an acquisition that year. So that'd be helpful to take a look at. Or, okay, it looks like operating margins, it went from 30 to 10. That's not good. Just real basic, you can get an idea of how the business is doing at a deeper level. So again, I'm doing a terrible job of actually answering the questions, but a little bit more to it, I think, than just ratios.
Yeah, that makes sense. Ratios have a place when you're starting, but long term, understanding the business is a lot more useful. I'd agree with you, sir. Okay, so I think that's it, actually. Thanks a million, Nathan, for joining us on the show. It's been a pleasure, and listening to your journey and what you've learned, and having someone that's wrote a book and on YouTube as well. It's an honor to have you on this show. So thanks a million for joining us.
It's an honor to be here. It's funny to hear you talk like that. I'm just a normal guy. Really nothing. It's nothing too special, really. I just enjoy teaching and helping people where I can. So it's been fun to be on. Thank you guys so much for having me. Thank you to your audience for listening and submitting some really thoughtful questions. So it's been a lot of fun. Thank you.
Thank you, Nathan. Also from my side, and we'll make sure we'll put the links in the descriptions from your YouTube channel, your book, and such. And if you have other information, also just drop us out after the show, and we will include it in here. And I can definitely see that you have really strong capabilities in education, because it's really nice to hear you talk about these kinds of topics. Thank you.
Thank you. Thank you for saying that. I appreciate it.
Okay. And to all our listeners, thanks again for tuning in, and we will talk to you all next week.